Over the next 20 years, $60 trillion is going to flow from baby boomers to heirs. Are those heirs going to be buying Procter & Gamble or be buying Bitcoin? Act accordingly.
As a QIB, both for my family office and the hedge funds, guess how much it costs me to borrow dollars against Bitcoin? Anybody? Zero. Who said zero first? Does that not enhance or prove the pristineness of that collateral?
Do you hear anybody in Bitcoin begging for a bailout? That nothing went wrong. They're already begging for backstops with this AI movement, right? What is the problem with the traditional system and what has wrecked their reputation? Socialism.
Everyone thought that gold was theirs, and then obviously that turned out to be, there's a policy change, and then that is not yours anymore. And so if you're looking to preserve your generational wealth, you have to take the steps into learning how to self-custody your asset.
This is not only a generational opportunity, but this has never occurred in human history. Never occurred in human history. There's not even 21 million, there's 19.2 million is the reality. So in the United States, I believe there's 58 million millionaires. Well, who doesn't want at least one?
We have an incredible panel here. Operators, allocators, and infrastructure builders who live in Bitcoin every day. This audience represents billions in deployable capital. We've got 40 minutes to give you some frameworks you can actually use. Let's kick it off. Why doesn't everybody take a moment to introduce themselves?
Hi, I'm Chantel. I'm the VP of Operations at Bitcoin Well. We're a self-custody by default publicly traded Bitcoin platform. Essentially what we do is we have two different services. We have our retail portal, which allows people to buy and sell Bitcoin completely self-custody, meaning that you're in complete control from the moment that you utilize our platform. And then we also have our Bitcoin Well Infinite division, and that's where we help complete larger transactions and complete more of a consulting service, so we can make sure that your family office or your estate is set up for success when you're purchasing Bitcoin through us. And really the difference from us from a different platform is that we do not hold your Bitcoin. So again, you're in complete control from the moment that you purchase it from us.
Chris Sullivan, co-founder and portfolio manager for Hyperion Decimus. We are one of the first hedge fund companies in the space.
CJ Konstantinos, founder of People's Reserve. We specialize in financial engineering, transforming Bitcoin from digital gold to pristine collateral.
Good morning. My name is Mark Hindley. I'm the CFO of HB Management. That is a Naples-based family office.
Mark, my first question here is for you. You told me recently in the past week that when you joined your family office, they had less than 1% exposure to Bitcoin, and your principals called Bitcoin garbage. Fast forward to today, you're over at 10% and growing. Can you walk us through the journey of education, myth debunking? How do you frame Bitcoin's value proposition to your principals now, and how did you get them from garbage to a 10% allocation?
Yeah, so Matt, thank you for that question. I think to simply and shortly answer the question, I think on a journey like this, you have to begin the journey and stay for a long period of time in the truths of Bitcoin to create conviction. Once you've established that, then you begin over time to layer in the theologies of Bitcoin. And I'll unpack that in a minute, but I want to set just a quick context and framework for this conversation. So my family office is a single family, first generation family office. The entire wealth creation event was created when through the scaling and the exit of a home services platform roll-up. So think plumbing, electric, HVAC. That journey biases all of our capital and investment allocation, blue collar, hard work, real world assets, and also how we value capital allocation. Traditional cash flows, EBITDA, expanding margins, et cetera. Nothing in our portfolio would scream to you high spec or high beta, right? As one example, even for us, when we go way out on the risk curve and we do a venture capital SaaS deal, the applications of that software are still in traditional manufacturing type businesses. So at a high level, that's where we started. So enter Bitcoin, right? No P&L, no cash flow, no EBITDA. I mean, what is it? Even if we thought that Bitcoin was a commodity play, I can't store bars of Bitcoin in a safe, and I can't go to Texas and drill Bitcoin out of a well and put it into a barrel, right? It's literally computer code in digital cyberspace,
John, hi.
right?
I'm Jack. Yeah.
So what happens? How do you journey from that starting point that really lenses over all the capital allocation to a Bitcoin allocation? In my opinion, and this is universal, the most effective way to break down and break through FUD, which is fear, uncertainty, and doubt, or misunderstandings about Bitcoin, is not price. Price is fickle, price is time-bound, and price is communicated or expressed in a perpetually debased fiat currency. In my opinion, universally, the most effective way to do the journey is to spend time in the sacred, infallible source text of Bitcoin, where you find the truths, which is the Bitcoin white paper. Self-custody, fixed supply, decentralization, privacy. If you can get your head around or begin conviction or create high conviction, which is the hurdle for any of our capital investments, you can then evolve into the theologies, right? And so that's where the journey begins. And I'll quickly kind of just run through some of the signposts that mark what that journey actually looks like that you asked. So one, Bitcoin becomes, or it's viewed as a vehicle, not just to grow wealth, but also to preserve wealth. When you think about a family office in the context of generations, you don't view Bitcoin in years, you view it in decades or in centuries. So within the context of trust beneficiaries and generational wealth, Bitcoin plays an incredible part on a large generational arc of your investment thesis. Number two is you actually, because you now have conviction rooted in the truth and not in what some professional line drawer on Twitter shows you with a bunch of red candles or a bunch of 100x levered perps dump on some Asian-based exchange, you don't sell. You actually step in and buy because your conviction isn't rooted in price. It's rooted in decentralization, scarcity, fixed supply. And the last thing I would say for a signpost would be you begin to question the TradFi industrial complex. And this is where some of the theologies of Bitcoin really, can I swap this? So when you begin to question, as a signpost, the TradFi industrial complex, this is where you start to layer in Bitcoin theologies. And I could go on for hours about the theologies, but I'll pick just three of my personal favorites that I think always resonate with my principles. Number one, there are more Wall Street sell-side analysts who cover Procter & Gamble than cover Bitcoin. Even though Bitcoin's $2 trillion market cap is 600% larger than Procter & Gamble. Literally diapers and toilet paper. Why? Right? Question number two, one of my favorites. Despite being the single greatest performing asset class of the last 3, 5, and 10 years, when I call our global niche, white glove, family office, global money center, wealth advisor, broker, I can't buy spot Bitcoin, but I can buy Procter & Gamble. Why? And I'll end with this, and this is my last point. Over the next 20 years, $60 trillion is going to flow from baby boomers to heirs. Are those heirs going to be buying Procter & Gamble or be buying Bitcoin? Act accordingly. And with that, just in summary, start with truth, later in theologies.
Wow, it's a banger. CJ, you're on deck. This one's for you. So to build on that, you describe Bitcoin as the most pristine collateral. For an audience that understands real estate, art, and securities as collateral, what does pristine mean in this context? And why is that a fundamental concept high net worth investors must understand?
Yeah, so I like to think about where we came from, where we're at now, and where we're going. And where we came from was gold was the underlying equity foundation of the entire system. And gold was a good collateral because it's hard, right? There's costs to pulling it out of the ground. You can't expand it infinitely. But there were a lot of problems with gold. You have to secure it. You have to transport it. And that creates friction within settlement. And that creates time. And time is money, right? So what do? We take a treasury and we say, we can fix this problem because now we have an interbank system that allows you to use a treasury as collateral and you're getting T+2, T+3 settlement. And we can fix that problem. But they created a new problem, which was we lost the hardness of gold, right? And the problem is with the treasuries, you can expand them infinitely. Maybe I'll try it like this. We can expand them infinitely. So we lose the hardness of gold, but we get the easiness of settlement. Enter Bitcoin. What does Bitcoin do? It gives you the best of both worlds. It upgrades the hardness of gold to absolute digital scarcity. There's only 21 million of them, and you cannot expand that supply. But at the same time, you get the best of the treasuries. Actually, it's an upgrade because it's not 2 or 3 days. It's actually 10 minutes. So now you get this quick, easy, secure settlement along with the hardness. And that's what makes Bitcoin, man, I'm not even kidding. That's what makes Bitcoin, that's what makes Bitcoin pristine collateral. Now, there's one more thing I want to add to this, and that is that in traditional markets, you all know this, the longer the term that you borrow the money, the higher the term premium, right? Because there's duration risk. So because it's proof of promise. So the longer the promise, the greater the chance that promise is broken. But what we're finding out with Bitcoin is that it flips that side. Because of the volatility of the asset class, short-term borrowing actually is higher risk. But because we're looking at an engineered money that was strategically designed to leverage the natural laws of economics to drive value into the network, over the long term, you get value accrual. So Bitcoin as pristine collateral takes duration risk and turns it into duration benefit. It is actually going to be Bitcoiners who are going to be the low-risk borrowers in the marketplace, not those who have the ability to tap into the printer and expand the collateral ad infinitum. And that is what we do at People's Reserve. I think that's what's really exciting about digital credit and Bitcoin-powered finance. There's a new equity layer foundation that creates a sustainable mechanism for lower interest rates without stating them or anchoring or having to perform yield curve control, because the collateral itself reduces the duration risk. You don't need a third party to step in and inject liquidity.
Could I just thank John and Jack for having us all here? What they just said, the two of them just gave you one of the most dynamic consolidated synopsis of pure raw alpha in the description of what Bitcoin can be for all of us, that I really want to get a round of applause for John and Jack for doing this. I mean, I've probably done over 1,000 of these between podcasts and speaking, and that was as good as I could ever have said it myself or that I've ever heard. And I just want to jump in on the pristineness. Do you realize that part of the way you can tell how good collateral is a person's willing to lend on it, right? And then, because that's a private negotiated market, not a commanded or mandated rate from above or below, depending on your view, then you can really gauge the quality of that collateral. As a QIB, both for my family office and the hedge funds, guess how much it costs me to borrow dollars against Bitcoin? Anybody? 20%. Nope, not even close. 0. Who said 0 first? Gabe. Yeah, so does that not enhance or prove the pristineness of that collateral? And so I just wanted to add to all of what both Mark and CJ were saying to show you a real-world market application of humans transacting free of mandate to determine who the transaction itself and the interest rate. So just want to point that out.
Wow, we got to talk after this. 0%. It's pretty
For
solid.
me, maybe not for you.
Oh, not for me. Chantel, this one's for you. Your firm's mission is preserving generational wealth through self-custody Bitcoin. This is a stark departure from how ultra-high net worth families typically hold assets. Walk us through the philosophical and practical case for self-custody versus institutional custodians. What does self-custody mean for Bitcoin? Why is that part of a balanced strategy?
When we talk about preserving generational wealth or creating generational wealth, it doesn't only mean preserving the number go up aspect or preserving the value of it. What it means is preserving access to generational wealth. And so that's why self-custody becomes so important, and why yes, it is a stark contrast to what we're typically used to. However, it removes all of the counterparty risk. When you have the ability to set up a multi-signature strategy and policy within your family trust and make sure that your team is on your side and you're not having to rely on any custodians, or subjecting yourself to risks such as bankruptcy and what happens to my assets if there's bankruptcy or if there's theft within the exchange. There's been so many different instances in history, not only from, say, a custodian exchange perspective, but even going back to gold. I mean, everyone thought that gold was theirs, and then obviously that turned out to be, there's a policy change, and then that is not yours anymore. And so if you're looking to preserve your generational wealth, you have to take the steps into learning how to self-custody your assets. And Bitcoin is the first asset that we have the ability to self-custody. We finally have the ability to become our own banks, and it's our responsibility to learn how to do that. There are a lot more steps, of course, and it's going to be some more education in regards to learning how to do this properly. But one of the things that we do at Bitcoin Vault Infinite is make sure that you and your family are set up for success so that you are in complete control and you don't have to trust us with managing your assets. There are still going to be roles for custodians in the market, but if you are looking at typical allocation, allocate majority of the Bitcoin that you want to consider that as the generational wealth layer in self-custody. And then, maybe if you need some for liquidity purposes, then leave it with a custodian. But if you are leaving it with a custodian, do your research. Look at their terms and conditions. If they go bankrupt or if there's an insider risk, make sure that your assets are not held up in that. Make sure that they are truthfully yours. And so why we think it's so important to self-custody is, again, because you have to make sure that if you want to create generational wealth, that your family in the future has access to it. And if you leave it with a custodian, you can't guarantee that that's going to happen.
Fantastic. Chris, this one's for you. As our panel's chartered market technician with a background at Morgan Stanley, you're deep into trading and modeling. I know many on the panel here would advise a buy and hold strategy, and I'm sure you do advise that as well in some capacity, but you offer other opportunities when it comes to trading to create some alpha. How do you advise a family office to get involved in that, and how do you use your technical analysis skills to model its famous volatility? And how do you analyze its correlation when it acts like a tech stock one day and a crisis hedge the next?
That's going to take a while. Let's reverse engineer and the unpacking of that. How do we harness volatility? It's through quantitative methods. TA is one quantitative method. Essentially, the maths you can parse out second, third derivatives, rate of change, volatility, contraction, expansion. There's a lot of factors you can code up that you can monetize in many different factions. For example, markets tend to trend. So if I'm running a quant fund, which I do, then I'm going to overweight my exposure to trending systems, right? To monetize the majority of the trend to the nth degree as a profit seeker, right? Then what I do with those profits, which is where part of the question you asked, is redeploy them into additional spot. So what we're doing is doing a best of kind of both worlds. We definitely are, if your allocation plan is I'm going to do a percent of crypto or Bitcoin, which should be Bitcoin, you need to go and just buy it. What Chantel just said, this is not only a generational opportunity, but this has never occurred in human history. Never occurred in human history. There's not even 21 million, there's 19.2 million is the reality. So in the United States, I believe there's 58 million millionaires. Well, who doesn't want at least one? And what our recommendation, because this is what we do at my family office, is at least one per person in your family. And that will protect you in a way that nothing else will, by sort of relitigating whether you should even have a counterparty control your assets at all. Some of you might be old enough to have received stock certificates where you actually had the material property rights to stocks. Currently, you don't have those. So this is a super unique, I would say, still early opportunity. But just to get back to the more dynamic parsing out of strategies, when you look at how to monetize something with what was 180 vol, now it's more like a 40 vol, you're trying to pair alphas to be accretive as one portfolio. So you want essentially each strategy to be orthogonal. What does that mean? Non-correlated to one another. So common phrases that people use to describe this stuff is mean reversion, momentum, stat arb, trend following, market neutral. So what we do is start with that discipline, and then we overweight or underweight based on market conditions and rebalance real time algorithmically with a macro overlay. So why do we do that? Because we want strategies that can win in any and all environment, because you can't fully predict the future. We might have a big chop range. Well, that means trend and momentum are not going to perform well, so we need stat arb, mean reversion, or market neutral. If we're in a giant volatile bear market, we want long, short momentum. So the way that we approach it with the backdrop of always building more spot. So one side of the fund is constantly adding. The other side is constantly producing. And that blend kind of smooths out the ride of Bitcoin over time. And we've been doing it, this is our 8th year as a hedge fund, and have been able to outperform Bitcoin by hundreds of percentage points.
Mark, once an office decides to allocate, the next question is how? From your SFO, single family office perspective, what's the due diligence framework? Do you stick to passive vehicles like an ETF, hold the asset directly, or do you consider a more active productional approach, like vertically integrating through Bitcoin mining? Obviously, this is an area I'm deeply involved in, and it's known for its huge information asymmetry. Also, obviously, huge tax benefits, 100% depreciation right now. How does a family office even begin to diligence that option and its potential arbitrage, acquiring Bitcoin at its cost of production? Is it worth the complexity?
That's a good question, and there's a lot there. I'll answer the question this way. When you consider Bitcoin miners, things like that, digital asset treasuries, let's put all those things in the bucket of Bitcoin or crypto adjacent opportunities. Fact, over the last 3 years, there's been tremendous alpha versus spot Bitcoin in those buckets. For example, not financial advice, this is just math. Over the last 3 years, Robinhood, Coinbase have vastly outperformed spot Bitcoin. There's this other company called like MicroStrike. I'm sorry, MicroStretch. No, it's a software company, and they do something with Bitcoin, and it's done pretty well. I'm sorry, don't poke the goat, right? So the truth is, you can move outside spot Bitcoin and find tremendous alpha. Our problem is really a Sharpe ratio problem, right? Since the Bitcoin ETF launch, spot Bitcoin Sharpe ratio went from 2.7, which is a measure of vol to risk, down to 1.4. So we've seen a 50% drop in Sharpe ratio in Bitcoin post-ETF. We like that. Most of the public miners, and you can just Google this, trade north of a 3 Sharpe ratio. Again, going back to what I said before, when you still have, or you view yourself as a relatively conservative allocator, plus 3% Sharpe ratios just do not fit our model. And so I would say maybe in phase 2 of the journey, we say, can we do some +2, +3, some hedge funds that will outperform? But for us, it's just a Sharpe ratio problem at the moment, going outside spot Bitcoin.
Makes good sense. CJ, for families who have been sitting on the sidelines, what framework should they use to determine entry points? Should they be dollar cost averaging, waiting for specific on-chain signals, or thinking in lump sum deployments? How do you advise they avoid the psychological trap of waiting for the bottom?
Well, thank you for the opportunity for me to give financial advice, Matty. I appreciate that.
Everybody's accredited here, so you're good.
So I think, the number one thing that we should be looking, here I go again, the doubles. The number one thing I should be looking at, I think, is Bitcoin's cost of production. So if you're looking for an entry point, and there's 2 parts to this answer. If you're looking for an entry point, you should understand cost of production. And if you need advice on that, go to Matty, because he knows cost of production. But I think right now, would you agree, Matty, it's around like 70 to 75 on average, right? And
It really depends where you're at.
Yeah,
It's such
if you're in
diverse
Ethiopia, yeah, it's way down. But on average, it's around 75,000. So when you look at the market price and you put it relative to the cost of production, that gives you a good idea whether or not you're going to get a premium or a discount, right? And that's very easy to relate to real estate. Everybody in here understands that if you see the price of real estate below the replacement cost, it's like, wow, yeah, we really have to take a deeper look at this opportunity because we're getting big value here. And if the price is too far above the replacement cost, it's like, well, are we chasing this opportunity here? What defines this premium? Why are we paying this premium? So if you're looking for an entry point, that's where I would start. Look at the market price relative to cost of production to understand whether you're going to be paying a premium or a discount. Now, the second part here is, and I think this is what's so exciting about the future of Bitcoin, is that it's no longer just solving the store value problem. With what you see Saylor doing at MicroStretch or something like that. What do you see Saylor doing, right? We have the honor of seeing him speak later today. It's going to be amazing. Amen. But with digital credit and Bitcoin-powered finance, Bitcoin is now solving other problems. So we're no longer just solving the store value problem when you hold Bitcoin spot. We are now seeing financial engineering and plugging Bitcoin into different products and services that create cash flow and guaranteed access to affordable credit, or if you're Chris, free credit. So that is really amazing because you can answer different portions of your portfolio, right? Everybody loves to talk about the investing side of their portfolio, but everybody also has a lending side of their portfolio. So you have diversification within your investments. What about diversification within your lending? Are you just lending your money to the government? Because there's other people you can lend to. And by the way, they don't have the ability to print the collateral. So remember, you can get access to Bitcoin through many different methods, and now it's solving multiple problems. So through strategies, multiple preferred offerings, you can now have a cash flow vehicle secured by Bitcoin, right? So you're not looking for massive upside. You're looking for cash flow that is going to continuously produce. And by the way, it's going to produce at a rate that creates a positive real rate of return, right? It properly incentivizes saving over investing. Right now, if you believe the government, I'm sorry, but CPI is not 2%. It's not. Everybody in this room knows that price costs are going up much higher than that. So even at a 4% rate, I think the real rate of return is negative. So the price you're paying for that cash flow is a negative real rate of return. To me, that's unacceptable because the laws of economics would tell you, hey, when the rate is negative, you should be spending or investing, not saving. But now we see a structured product that takes Bitcoin's engineered design and creates a cash flow from it. So that's really amazing. And then you say, well, what other reasons could I have besides storing value and generating cash flow at a real positive rate of return? Well, access to credit. Because now you're talking about a commodity credit. It's no longer proof of promise. It is an equity layer foundation that eliminates risk for the lender. So at People's Reserve, we have a Bitcoin-powered mortgage. One of the reasons we're able to offer rates that are the lowest in the world for home buyers is because when you come to us to buy your home, you are posting Bitcoin collateral, so the loan is secured by the property title and the collateral itself. LTVs usually start around 50%. So from the lending perspective, we don't need to package this together and sell it off to Fannie and Freddie because it's high risk and it's a long-term proof of promise. There is an equity component to the debt, and that secures the debt. So if you need something on your balance sheet that you want to leverage, it's much better to be able to leverage against Bitcoin and take a little risk here and there. It's much better to add Bitcoin to create cash flows with these preferred offerings. And of course, there's no better way to store value than Bitcoin. But that's what's so interesting right now. It's not just about using it as a store of value. Now we can hit cash flow. Now we can hit affordable access to cheap credit. And for those three reasons, who really cares about what the premium is, right? If you can capture a discount, capture it. But if it's trading at a premium, that's why it's trading at a premium. Because you can now do these multiple things with it that it's so new, we've never seen it before. So the whole world is kind of just flabbergasted right now. And if you feel 100,000 to 75,000 is a justified premium, that's kind of like saying the MNAV on strategy right now is justified. It's not. When you see what they're building and what they're building towards and the liquidity that's going to flow in and how that value accrues to shareholders, because they only have to pay out the 10%, but we have, 60% CAGR, they are arbing that. That's their profitability. That goes back into the company. So take advantage of the misunderstanding in the marketplace right now and understand it's not just a store of value. With financial engineering, it's a cash flow product and it's access to the cheapest credit in the world.
That was good. Some good alpha there. Chantel, this one's for you. Let's get practical here. How does Bitcoin Well operationally onboard a high net worth family office that wants to self-custody? What does the actual playbook look like there? Are you walking them through multi-sig, geographic distribution of keys, succession planning? How would you onboard somebody?
Yeah, absolutely. Thanks. Yeah, so one of the first steps when onboarding any family, any individual, any trust is first off setting a meeting with them and getting a really good understanding of what are their goals, what are your knowledge, or where's your knowledge in Bitcoin. Have you ever set up a self-custody wallet before? And once we have that meeting with them, we really get a good understanding as to, okay, you know, should we be helping you or advising you to set up a trust, or are you going to be buying this through your business? Then we get all the stakeholders involved, say if we're going to be setting up a multi-sig structure within their organization or within their trust. We make sure that everybody completely understands what it means to hold your private keys, how to safely, securely store them, manage them, make sure that there's redundancy built so that you're not ever losing access. And then just being there to essentially answer any questions and make sure that they leave that meeting itself with enough confidence so that there will be no mistakes of, say, key loss. And after that, that's when we would really help them actually design the actual strategy of the multi-sig setup. So helping them get hardware wallets, going through the process of testing out transactions before we're purchasing a large sum of Bitcoin on their behalf. And then once all of that testing is done, the governance plan is essentially created for them. That's when we would move forward with the actual transaction itself. When we're transacting, essentially a customer would send us over a wire transfer. We would buy that Bitcoin right then and then send them Bitcoin to their self-custody wallet that is in their complete control. And one of the things that's very important to be doing is consistent follow-up, making sure that, you know, in every quarter, do you still have access to your keys? Do we need to be testing everything out, signing a transaction, making sure that the hardware wallets are still working? And if not, let's get those keys imported into a new hardware wallet so that if there's an emergency situation and you need to move everything very quickly, then you're not stuck, stressed, panicking, and nothing's working. Let's just start proactively planning any emergency drills so that you can always have access to your Bitcoin.
Well said. We've got about 9 minutes left, so I'm going to ask a question for the next 4 minutes, and we can all kind of opine on it a little bit, and then maybe we'll do 5 minutes of Q&A at the end. We'll start with you here, Mark. Let's address two elephants in the room for every family office: regulation and volatility. Mark, from your time at Cogent Bank, how did you diligence regulatory risk for a chartered bank? How are things changing with subjective terms like reputational risk?
I did not share in my bio earlier that prior to the family office, I worked for years building within a regulated FDIC bank, a crypto digital asset friendly bank within a commercial bank, which is how I met some of the folks that are here today. So at that time, keep in mind, when I was there, to your point, this is pre-FTX, pre-Celsius, pre-everything. And that's such a complex question. All I would say very simply is when you read articles now about the pro-crypto administration, what that really means is clarifying rules that have been unclear or highly biased against non-traditional assets for decades. When I was trying to build the crypto bank within the FDIC structure, I met with the FDIC regulators out of Atlanta, who was our primary regulator. They didn't even know what Bitcoin was. You cannot write policy or guardrails when you don't even understand what you're doing, let alone the KYC, AML, FinCEN, et cetera. So there's a lot there. What I would say is there's huge progress, clarity, all the laws on the books. And I think this administration, relative to the framework, will literally usher in a very different dynamic. But when I was there, it was brutal. Choke point, all the things you heard about, it's all true. Like, it's not just a bunch of like the moon is flat, or I'm sorry, never went to the moon. Earth is flat. No, my bad.
The moon was made of cheese.
Yeah, no, my bad.
The moon was cheese.
There's a lot there, but I just generally speaking, there's a lot of really good things happening right now within that space, and I think as it evolves, it's good for obviously adoption and obviously price appreciation.
I think I understood the question. No. I think I'll go with this, though. Let's say we're going to invest $1 trillion to expand our infrastructure, and we want to have a good reputation. So what do we do? Oh, here we go. I am the best. Something about my voice, guys. I don't know. So we want to invest $1 trillion in infrastructure, and we want to have a good, strong reputation. So what do? We beg the government to backstop our private credit, right? Oops. Yeah, okay. Do you hear anybody in Bitcoin begging for a bailout? That nothing went wrong. They're already begging for backstops with this AI movement, right? What is the problem with the traditional system, and what has wrecked their reputation? Socialism. Socialism for the extremely wealthy and the extremely rich who don't care about other people and only care about themselves. And what that has done, it has introduced a problem into the natural market cycle. With that type of reputational risk, like, we don't want to fail, we don't want to learn from our failures, we want to get bailed out, we are missing the credit destruction part of the cycle. That's what's happening. So the traditional system is not allowed to fail. It's too big to fail. And what happens is you have to print through it. But when you look at a business cycle, failure is a must. Could you imagine if FTX was still around today? Because they got bailed out because they were too big to fail? What does that mean for the industry? So I think Bitcoin comes in and says, you know what? Let's have a natural market cycle. Let's let the over-leverage, the mismanage, and the fraud fail. Let's not ask for a bailout. And in that way, we'll develop our own reputation, a reputation for true free market. And you have regulators and, they're trying their best. And we're fighting against China, and we're fighting against Russia, and we're fighting against people who can print and invest. Chris and I were talking about that backstage. So you got to play the game. But the best way to play the game is to let the free market do its thing. Because when you wash out the leverage, and that's what happens in Bitcoin. If you're over-leveraged or mismanaged in Bitcoin, with no mercy, you are destroyed. And what happens? We build from a stronger foundation. That's why we look at Bitcoin, and we don't really care about the highs. If you've been Bitcoin for a long time, who cares about the highs? It's about the lows. And they keep going up by design, because when you get that over-leverage, when you get that speculative bubble, when it comes back down to reality, when you get the reversion to the mean, all of that gets washed away. And when it gets washed away, you build from a stronger foundation. And you know what? In the long term, it's easier to regulate an industry that allows failure. It's easier to regulate and build an industry that builds from a strong foundation of rock rather than a weak foundation of sand and walls and bailouts and printing. And I think for that reason, in the long run, the regulation will actually become easier. And then the market will be empowered by true free market dynamics rather than what we call now capitalism, maybe socialist capitalism. And we can move into a true free market capitalist market with real price discovery, regulations that actually protect investors, and then washouts that actually get rid of the bad ideas, get rid of the bad managers who are underperforming, and most importantly, get rid of the fraud.
Great answer.
I'll try and go a little faster to address all of the above. One, without the ending of the central banking system, there is no such thing as free markets. So we're not in one. We've never actually been in one, except if you go pre-1812, and then maybe a brief period after Andrew Jackson killed the bank. But otherwise, it has not been a free market. Then in terms of volatility, if you are concerned about volatility, you're doing it wrong and should go home. Volatility is your opportunity, not your risk. Then on regulation, I've worked with FBVA, Bitcoin Bay guys, since 2017, we've actually passed 4 pieces of legislation here in Florida. I was recently in DC, literally on Capitol Hill the day before the shutdown, which was fun, advising on the market structure, 2 days before the shutdown, discussing and advising on the market structure bill, crypto market structure bill. I can tell you with faith, having also gone to law school, there is no such thing as a good regulation. Regulations are written and designed by those who want to stifle out competition. So a family office should not consider any regulatory overshoot or undershoot and should invest with only alpha production in mind.
All right, what do you got, Chantel?
Yeah, you know what, I guess I just echo that sentiment as to what Chris had said. I don't think that, you know, we cannot be regulating the markets and, oh, sorry. Is that one working? Oh, all of them? Both of them at once. Yeah, sorry. I think that, you know, as regulation goes in, I do completely agree that it is going to be stifling innovation in a lot of senses. Going back to what you had said about, about the, sorry, can you repeat? Sorry.
I'll repeat the question here. So, how do we address the 2 elements in the room here for family offices, regulation and volatility? Obviously, you have a publicly traded company, so you know a lot about the former.
Yes. Okay. Sorry about that, guys. Restarting. Yeah. So when we have to look at regulation, I think that what is important to evaluate when you're entering the market is looking at who you're partnering with from a regulatory standpoint. So you don't want to be, say, if you're purchasing Bitcoin and you're dealing with a company that is unregulated, it's going to put a ton of risk on your family office. And so you have to be looking at, back to what you had said about, you know, it's the MTL registrations. Are they doing KYC? Are they doing KYB on you? I think it's important to make sure that you're following the correct procedures and that the business that you're dealing with or purchasing the Bitcoin through or the custodian that you're dealing with is going to be regulated so that you're not putting your family or family office at risk. In terms of the volatility itself, again, I think that the volatility is a feature and not a bug. The volatility gives you that opportunity to be getting in at a lower market. And you know what it also does is the volatility creates interest with the general market, which increases adoption. A lot of times, you know, when the number goes up, that's when people start talking about Bitcoin again. And I think that, you know, as Bitcoin becomes further adopted and as that number is going up, it's just going to be obviously beneficial for everybody's investments.
I'm told we've run a little bit over, so we're not going to do a Q&A session, but if you do have questions, come talk to us in the hallways. I just want to thank all of you for coming today and giving such a great panel, such a great speech. Thank you, guys.